workshops around it, it's just connected, so on. So trying to enable the overall VC ecosystem to look at cybersecurity and data protection as an area to explore. But fundraising has always been a kind of a complex exercise for the companies, right? Whether it's a negotiation in terms of valuation, and it's not just limiting at the negotiation level, right? It goes beyond that. It involves finance, then statutory and legal aspects, and so on and so forth. Starting from the nitty-gritties involved in evaluation to due diligence, defining the term sheets, how to negotiate in terms of the terms and signing off those term sheets. Those things are quite complex, right? And our core technocrats working on the founders of our cybersecurity product companies and data protection product companies, they are trying to find out ways to sort out these issues. In recent past, definitely we have seen significant jump in terms of fundraise in cybersecurity. Last year itself, during this COVID time frame, quite a decent funding happened for Indian cybersecurity companies. With that, we thought to have a kind of a session or even a series of sessions, starting with this fundraise and then probably having different aspects on, say, corporate governance, then your merger acquisitions, employee stock options, and those kind of things. So here I would like to thank Khitan Legal Associates, especially Ms. Shruti and Ms. Aditi, for joining hand with us and enabling us to host this workshop for our entrepreneurs. So today I can see a lot of cybersecurity are dominated by cybersecurity product companies, definitely, but a lot of diverse stakeholders are also here. And today it would be the first one where we'll be talking about the fundraise conundrum. And after that, we'll have a couple of more workshops, 3 more workshops we are planning. One is on corporate governance, merger acquisition, as I said, and employee options. For that, timelines will be provided by you. My colleague Deepak is here. He'll be talking about it towards the end of the workshop. So with this, again, thanks a lot, Khitan Legal Team, Ms. Shruti, Ms. Aditi, for joining us. And I would request and hand over it to you to take it up. I hope this session would be fruitful for all the participants joining today. And we will be looking for your suggestions. If you want to add a couple of more things in future, we'll definitely try to do that. So over to you, Ms. Shruti and Aditi.
Thank you so much, Atul, and thank you for that very, very relevant context creation. And I think you have perhaps given us the tip of the iceberg that, you know, in the technology domain, what they know well is what the world out there doesn't know, which is technology and how to use it and how to keep innovating and creating it forward. So for some of those ancillary and incidental things that they must not waste their time on, which is understanding the legal constructs and understanding the, aspects around other areas that make them go around with their normal day-to-day business can best be left to some of us here, Aditi, me, and our firm, and we'll be absolutely happy to see how we can take that burden of understanding, some of these unnecessary complexities and be able to support them in it. So thank you for giving us the opportunity of being of service in this space. And yes, like you said, this is the first one of the 4 workshops that we are co-curating with DSCI and you, and with your support, of course. We'll be happy to keep this as an ongoing conversation, Atul, like you rightly mentioned, that it's not that the conversation ends at the end of the 1 hour today, but perhaps that's where the conversation starts, and we are absolutely available to keep answering any queries, questions, or concerns that any of the participants may want to seek of us, and we'll be happy to support that. Okay, with that as the background, hello everyone once again and welcome. Thank you for taking out the time and being with us and spending some time in contributing to us by your presence and obviously your questions. I'm sure at the end of the session, Aditi and I will take back a lot more areas to explore, delve in, and be aware of, especially in the technology business space. That may also, form part of your queries and concerns as we move along. So, funding is perhaps that magic word which can be the panacea to all the troubles young entrepreneurs can think of in their journey of creation and transformation of an idea into successful businesses. So clearly, it is the answer to all problems and troubles, because obviously a large part of creation and ideation and putting them to fruition depends on funding and fundraisers. But I think something more fundamental to it is more important. Is before we ask of funding or before we think of funding as a tool, we should be having a very astute assessment of where we are in our journey as a startup and for what will we be needing that funding. So, basically, essentially, the stage and the requirement is extremely important for you to be able to validly and transparently put it out there as a request to people who form the relevant financing sources depending on the stage of your startup journey that you may be on. The only other thing that perhaps you also need to have some assessment of is any uncalled for exigencies or unexpected circumstances that are specific or peculiar to you, your industry type, or in the industry at that moment that is prevalent, or the ecosystem that's prevalent. So why I say this assessment is necessary is because what funding you need will be absolutely needed to accurately match the stage and the requirement of your journey. So for example, if you're requiring the funding to hire a team, that may not be a valid request at the seed stage or ideation stage. You may perhaps need money to fund or finance some other more critical and impending requirements, such as proof of concept, pilot, or product development spaces. But that said, some of the key reasons or asks in our experience that we found startup founders and CEOs going out and asking or seeking for financial support is for, like we just said, product or website development, resources and raw material or equipment requirements, working capital requirements, at the relevant stage for expansion and advertising, so to speak. And of course, the relevance and the criticality of each stage and the kind of funding sources for each stage and the legal framework of documents and conversations that are relevant to each stage is what we will shortly speak of and share our thoughts with you on. So in this conversation, as we move along, the idea is actually to just familiarize you with what constitutes the legal framework for making funding transactions a transparent and a seamless recordal of commitments that are made by investors to CEOs and founders and vice versa. This is very, very important because, while it may seem contrary to what one would think, but if you look at it, an investor and an investor's commitment is largely more immediate And whereas a founder or a startup's promises are more in the near future. So clearly, the recordal of circumstances as on today and the recordal of promises as they will play out over a period of time, where relevance and how are we looking at it and recording it in a very fair and transparent manner. What becomes very essential also through the process as we go along and as we will speak about is the need and requirement for a continuous monitoring of what we set out in the initial set of documents and conversation recordal processes. So given what this is and how how perhaps the journey starts once we have received a firm commitment from one of our fund sources or financing agencies, we kind of we think that we are perhaps at we've accomplished everything that we needed to by getting a commitment. But how do we kind of record the commitment is where perhaps, as I think of it, the journey starts. And I think for this, I thought it'd be best that I will have one of our experts at Khaitan Legal Associates, jump in here. And she clearly is the champion of all the transactions that happen in this space. She's also a dear colleague and obviously is more suited and relevant to share her experiences, because like I was talking just before we began, she does these transactions 24/7. Even in her sleep, she can perhaps help some of us understand some very complex aspects around funding transactions that start, especially in the startup space. So Aditi, of course, you have Aditi Chandak right here. She's the expert and champion I'm talking about. So yeah, and before I hand it over to you, Aditi, I must let you know, I am on the side of the founders and the CEOs and the other audience and participants. So till we have time for Q&A, which will be right at the end, I'll continue to interrupt you and keep asking you all the tough questions on their behalf. So over to you.
Thank you so much, Shruti. Thank you for your kind words and for the ever-present guidance that I get at Khaitan Legal Associates. Happy to take it on.
Okay, so I think I spoke about the importance of funding. So maybe you want to tell me, do you want to go through this a little before we jump into the other slides?
Yeah. So as an overview, we'd be covering the importance of funding and funding at the right time, the various types of financing, different stages at which a funding needs to take place, importance of the transaction documents, which essentially includes the term sheet, the agreements, the process that it takes from a term sheet to a closing, and then fulfilling all the post-closing actions. So that's the overview.
So this is largely the definition of startup. I think every one of us here will be aware of it. And Dharashil, do you want me to speak louder or Aditi to speak louder? If you will put it in the chat box, we'll make the necessary corrections. And yes, so Aditi, we were talking about importance of funding. Please go ahead.
Right, how you rightly pointed out, Shruti, that the importance of funding comes from the time at the requirement of funding occurs. Essentially, the type of the requirement of funding should match the source of funding. Funding can be needed for the purposes of product and website development. It could be for building building and hiring a skillful team. It could be for any sort of working capital requirements, any capital expenditure requirements, or it could also be for expansion and growth. So it is very important to understand the requirement of funding and the stage at which a startup is to match the need of funding to the kind of documentation and the kind of instrument and whether the kind of capital that will be required, whether it would be equity or it would be debt.
Got it. So would you be then taking us through what actually are the stages? I think I've spoken about it, and you're also belaboring the point of the stages. Perhaps it's best that you could help us with some details around what are those stages and what's in store with each of these stages.
Absolutely. So the entire startup has a life cycle, as we all know. The first step in the life cycle of a startup is the stage of ideation. This is essentially the stage wherein an idea is brought to life. The requirement of funding is typically small amounts of funding that are required. It is either done by through self-financing or through friends and family. Given that the stage is such at a nascent stage that you could only reach out to your friends and family who trust you and who trust in your idea. So this is generally simple, and it is primarily done by either self-financing or through friends and family. The next stage.
Yeah. Is it necessary at this stage, Aditi, to kind of, while I understand it's more informal, would it be fair to have a simple record or a document, a simple document that records what they've done here, or is that something we can let go at this stage?
It's always good to have it recorded. As in a simple paperwork like a 2-3 pager document which records the issuance of shares. We also have certain compliances around the Companies Act wherein we issue shares either through private placement or through a rights issue. So those documentations will anyway need to be done, and the same would need to be filed with the ROC. So given that there is documentation to that effect, recording the issuance of shares, but it's always good to have a very simple document to record all the terms and conditions on which such shares have been issued.
Got it. Thanks for that.
So I'll move on to the next stage. The next stage is the validation stage. Essentially, this stage is very critical given that the prototype is ready and there is a need to validate the demand for the product and services of the startup. This stage is generally backed by either government loans, any schemes offered by the government, and also the angel investors play a very important role here. They not only provide the money to the startups, they also act as a guide to the startups. So here the angel investors, I would say there is a lot of documentation that needs to be done, but they're generally more flexible than a VC. So they don't come with their terms are flexible, and they don't demand for rigid covenants in the documents. So it is simpler than a VC.
Got it. Thanks.
So the third stage I would want to highlight is the early traction stage, wherein this is the stage wherein the product and services are already launched in the market. The key parameters to evaluate the performance of a startup would be dependent on the customer base, the revenue, the application, and the downloads. So these are a couple of things basis which you can determine the health and the performance rate of a startup. This is the stage wherein the right set of investors need to come to the cap table of a startup. It could be any venture capital fund. It could also be procurement of funding through debt from banks and NBFCs, and also venture capital debt funds.
So this is largely where the first level, where institutional investors of some sort kind of come in.
Absolutely.
Got it.
The next stage is the stage of scaling, wherein there's a fast rate of market growth. There are increasing revenues, and the startup is established and has created a presence in the corporate market. This stage involves funding from venture capital funds, private equity investment funds, and here it is very important to take note of all the terms that we're offering to the institutional investors and to these venture capital funds, especially in the early traction stage, because that sets a bar for the scaling stage. So it becomes very important how we negotiate the transaction at the stage of early traction and at the stage of scaling.
Got it. Got it.
The last stage being the stage of exit, not purely from a funding perspective, but from a life cycle perspective of a startup. This stage involves providing an exit to the existing shareholders of the company. This exit could be by means of providing an IPO, selling shares through a strategic sale or a third-party sale, buyback. These are a few mechanisms which are used to provide existing shareholders an exit from the company.
Got it. And that's at the stage once they have perhaps spent some time in making the company into a particular size. I think, from a funding perspective, Aditi, what's interesting for me and what's intriguing is that, we largely see equity as the mode of funding. And I think the popular belief out there is that the loans are expensive and hard to come by, or venture debt is perhaps, it's lesser heard as an option as such. Would you be able to share some thoughts on that? Okay, there's your slide on the question I'm asking.
Yes, so it's equity versus debt. The debt is also picking up. Venture debt is picking up in the market. Essentially, if one goes for a debt, the tenure period for the investment is typically ranging from 1 to 3 years, whereas in case of an equity, it ranges from 5 to 10 years. If a founder opts for debt, the advantage is that there is no dilution of its equity stake in the company, whereas in equity, he's bound to lose his capital. And from a cost of capital perspective, in case of a debt, one needs to give periodic interests. And this interest can range between 12 to 18%, whereas in case of an equity, no periodic payment is required, but the investors expect a IRR on the investment that they have made. And this, from an equity perspective, it would only be possible when the investor sells its shares, will he get an exit from the company, whereas in case of debt, there is a defined term for which the debt is available. So if I would want to add, while private equity transactions and IPOs are in vogue, many Indian startups are now also raising debt to fund their working capital requirements through venture debt funds. So essentially, depending on the business of the startup would end up taking a mixed bag of both equity and debt to keep its business running between two rounds of funding, essentially.
What would I typically use debt for? Basically for working capital and between funding. Is that what you say?
Yes. So the use case would be like as a runway extension between two rounds of funding. It could be for working capital. It could be for any sort of midterm small capital requirements. Whereas in case of equity, it's generally for expansion and development, and working on upgrading the product, or say hiring a skillful team. That's where one looks at equity as an option.
Got it. And I think what debt also serves for, give it in the interim, not, it kind of protects the dilution of equity, as you rightly mentioned, so that for midterm or short term, or between significant rounds, debt could be a good option to look at. That's interesting. I think that we largely miss, because we think that perhaps it may be a little more cumbersome from an obligation and a cost perspective. But yeah, I'm happy and glad that, like you said, people are looking beyond and seeing that there is merit in considering debt as well.
Yeah.
Okay, so let's see what you have. There comes the conundrum, that we were wanting to decode for everyone.
So this is essentially the process that it takes from finding the investor up till the investment happens. So it's typically divided into the term sheet stage, the due diligence stage, execution of transaction documents. Then following that is fulfillment of the condition precedents, moving to closing and the post-closing actions. While these stages are there, a few of these stages can run in the parallel, so as to save time. And in my view, I would say that it would typically take like about 2 to 3 months to close a deal from start to end. It also sometimes, if everything is in order and the diligence is completed in a systematic manner, then we can also close in a month's time.
Wow, that sounds like a plan. But, given there are so many stages and so many documents like you are trying to tell us, I mean, how important, they seem like a whole lot of work there. And term sheets in itself are a big, perhaps I won't call them a roadblock, but a big idea waiting to be understood better as to what's in it for us in term sheets. And maybe you can help us understand what that is and how critical is it, at what stage becomes really critical. So some of those questions, I'm sure are sitting out there, and if you can help us understand those.
Yeah, so generally at the early stages, we as founders, they tend to skip the stage of term sheet and just jump to the transaction documents. However, the advice would always be to have a foundational document in place. A term sheet acts as the principal document wherein the intent of the parties are set out. The key terms of the transactions are set out from a commercial as well as legal standpoint. From a founder perspective and an investor perspective, it would have rights such as management rights, including board seats, the right to appoint a key managerial person in a company, or for that matter, any affirmative voting rights. From a management perspective, there are also terms such as for the shareholder rights, which includes the tag-along rights, the right of first refusal, the right to exit, and the mechanisms in which the founders would provide exit on a best effort basis to the investors. So these terms, if are identified and put up front and agreed up front, it becomes easy to close the transaction documents, the definitive documents, in a speedy manner. Now, it also ensures.
So why is it necessary to have some of these fundamental rights to be understood at a term sheet stage? Now, tag along right, or is something which will be better understood in the larger context of a shareholders agreement. But why should we have clarity at a term sheet stage on that?
So, what we've seen that there's a lot of back and forth on documents because there is not enough clarity as to what the founders are willing to give up and what the existing investors. So there are certain existing investors also in the company, and the term sheet generally is signed between the founders, the company, and the incoming investors. However, it is important to take note whether it will require board approval, and whether once the founders are signing the term sheet, they have looked back at the existing shareholder agreements to see that they're not in breach of those. So from that
because it's only fair that they are not, there are some early trust givers to the system. So in the run up for a newer and a bigger round and newer set of investors, you're absolutely right in saying that that trust needs to be completely built upon, and an eye on each of these documents is necessary so that we are not violative of any of the previous obligations as well. That's got it. That's helpful, Aditi.
And the next thing that I wanted to highlight in a term sheet are certain clauses which are binding in nature, such as the confidentiality clause, the exclusivity clause, and the validity of the term sheet, and provisions around governing law. So these are a few provisions which are binding in case of a term sheet. And especially, see, the validity of a term sheet becomes very important because that's the period it gives, it sets a timeline for the deal to be closed and the parties to work towards those timelines. Otherwise, it's like it's an open-ended thing that you sign the term sheet and it can go on forever. And so there has to be a validity period for the term sheet as well as exclusivity. During that period, the parties are required to exclusively discuss and negotiate the deal and bring it to closure.
You mean to say both parties are bound by exclusivity?
So
Both
generally
the
the founders
investors as also the founders?
The founders and the company are bound by such exclusivity conditions. However, in a few cases, we've also seen wherein the founders have made a request to for the investors to sign up on such exclusivity clauses to just invest in that particular space and discuss only with those founders in a particular space.
Got it.
And not in competition.
Okay. For the time period that they're negotiating with them, they may only, the request is to kind of not have discussions with similar or similarly placed entities.
Absolutely.
Got it. And then how do we make part of the document binding and how part of it non-binding? I mean, that sounds a little confusing to me.
So a term sheet is generally a memorandum of understanding. So it's just the intent is to capture the intention, the commercial intent, and the commercial intent of the parties. Along with it comes with a little bit of the legal provisions that need to be agreed upon. So the binding nature is limited to confidentiality, exclusivity, and governing law provisions under the term sheet.
Got it. Got it.
Because it's an agreement to enter into a transaction and agreement to go ahead with funding.
Got it. So it's an agreement to agree, but some things are sacrosanct because given information is shared in transparency and confidentiality should be maintained so that it doesn't cause any harm to either party, say for example.
Yes, absolutely.
Got it. And now I'm going to come and ask you some things on the biggest conundrum of all, which is due diligence. And the name in itself sounds a little complex and confusing, but it'll be really great if you can decode some of this for us.
So yeah, I've mostly seen founders, not putting a lot of attention here, or shying away from diligence. But diligence is important from both a founder as well as an investor perspective. From an investor perspective, obviously, to do a health check of the company and to pull out the red flags by doing a diligence of all the corporate compliances, the financial indebtedness, human resource, labor law and human resource compliances, any material contracts signed by the company, or any regulatory approvals required for functioning and conducting the business of a particular startup. So these checks need to be done by the investor before the investor puts in the money. So diligence is definitely important from a investor perspective, by doing a verification and a health check of the company. But it is also important from a founder perspective, as it gives the founder an idea where the risks lie also, and what has gone right till date and what has gone wrong. So it also shows light to the founders about the importance of these corporate compliances that they're required to do on an ongoing basis. So I would say it's an important one.
One thing, Aditi, that I just wanted to know, and this may perhaps also be a question out there. The criticality of due diligence is there for us to all of us to see it. Like you rightly mentioned, it gives the founders a structure of putting the right set of systems in place, and yes, they may have that really forms the basis of the trust and the trust build up with the investor from the health check perspective. But have you seen any things go all right just because the due diligence kind of sprung up some very, very big non-compliances, so to speak? Have you seen anything being that grave that, due diligence can kind of upset the apple cart at the word go?
So, Shruti, I would say that obviously there is a chance of such red flags coming up, but there are always at the stage of the early stage and the scaling stages. We always look at a way to resolve it. So either we resolve it if it's really critical to the transaction, then and it can be resolved. It is resolved as a condition precedent to the transaction, that is prior to the investor putting in the money. But if it's a call that the investor also needs to take in discussion with the founders to understand how critical the red flag or the non-compliance is and how one can resolve it. And if it's resolved and it's a light one, we can take it as also as a post-closing action, essentially.
So essentially, the benefit of doubt out there is for the startup founders that they may have missed it, the miss or the non-existence of that compliance is a bona fide mistake, or perhaps because they had more critical things vis-a-vis business to do, and it's not that they've missed it deliberately, because that perhaps may be a red flag that could trigger a go no go. But largely in your experience, we found investors to be amenable to regularizing it and not holding it as a penalty. Got it. Great. So I think now you will tell us a little about, well, just some very, very few transaction documents, as you call them. Please, could you please tell us what deals with what, and which kind of a document do we use for in what circumstances?
So again, Shruti, like we've discussed previously, it totally depends on the stage at which the startup is. If the startup is at a seed level, we're just taking investment from friends and family or angel investors, and there are not a lot of investors on the cap table. We end up doing one type of agreement to reduce the paperwork, and it's called the share subscription and the shareholders agreement, which essentially captures all the rights relating to issuance and the process, how the securities will be issued. And the shareholders agreement captures the intent of all the management rights and the shareholders' rights available to the investors, and the entire governance of the company, how that would function. So if I would say like a share subscription agreement would typically have the entire process of issuance of shares. It would also have certain reps and warranties that the founders would need to give. Now the reps and warranties would also depend on the stage at which the company is. So if it's an early stage, we end up giving limited warranties such as title, capacity, and authority, and a few basic reps and warranties around the conduct of business of the startup to give comfort to the investors. If it's at a scaling stage, then extensive reps and warranties are demanded by the investors for them to get comfort on the functioning of the company. So that's about a share subscription agreement and shareholders agreement. There's also a concept of an employment agreement, which is fundamental. This is the employment agreement that is executed between the company and the founders. This one needs to really define the roles and the duties of the founder. Because it's very important, because founders are responsible for the entire functioning of the company, and various covenants are put on the founder under the shareholders agreement in the capacity of a shareholder. But the employment agreement also should set out detailed rights, responsibilities, and duties of the founder, and the designation that the founder will be getting in the company. It also contains certain provisions around non-compete, non-solicit, protection of intellectual property, because any sort of intellectual property created during employment should belong to the company. And provisions around confidentiality are a few key provisions of the employment agreement.
So tell me something, and I know you briefly touched upon reps and warranties, and they are prepare perhaps to Atul and Deepak, a full workshop in its own as to how we kind of look at and what do we make of reps and warranties. So I'm not going to ask you that question here, Aditi. But how do I, as if I'm a founder, how do I discern between what goes into the employment agreement and how do I read it in conjunction with the shareholders agreement, so to speak? Because I'm a shareholder and I'm also a key employee of my startup, which I now have investors in. So how do I toggle between the two and see them collectively?
So Shruti, here I would like to add that the two roles are separate. They are distinct of each other. The shareholders agreement looks at the founders from a shareholder perspective, a person holding capital in the company and invested in the company. Whereas from an employment agreement, it is seen outside of the shareholders' purview, and it is an individual who is responsible for carrying out its responsibilities and duties and fulfilling any set of milestones that may be attached to the responsibilities and the duties. So they need to be read together as well as need to be looked separately.
Separate. Got it. Okay, I'm just itching to ask you what comes under this miscellaneous. That looks like a can of worms right there. I mean, it looks harmless, but I'm not sure what all you want to kind of tell us about in miscellaneous.
Right. So miscellaneous would actually just wanted to add here that there are multiple documents in a transaction. So, for example, if like for the one that I want to discuss first is the Articles of Association. So the Articles of Association of a company is the charter document of the company. It sets out how the company will be governed. So the provisions of the shareholders agreement need to form part of the AOA, and it needs to be adopted by the company, and necessary filings need to be made with the ROC. So the Articles of Association have to be read together with the shareholders agreement, and they have to read in line with each other. So an AOA, amending the Articles of Association, is a very important part of the entire transaction.
And the new investors will be very keen to see how the terms of the shareholders agreement are incorporated in the Articles of Association, I would imagine.
Absolutely. The second piece here is a disclosure letter. Again, this may not be relevant in cases of seed level stage, like at the ideation and the validation stage, given that funds are received from angel investors and family, and an angel investor may not request for a diligence and a high level diligence, or just do a high level diligence and not do a detailed diligence. But when we're at the stage of scaling and early stage and scaling, then there is diligence which is conducted and extensive reps and warranties are provided. So the disclosure letter is essentially a document wherein the founder is allowed to disclose any sort of facts which are against the rep and warranty that they are providing. So this needs to be very carefully drafted because it has a direct link to the indemnity provisions, and so it's directly linked to liability and risk.
Got it. And whatever they disclose there could perhaps come to their, it's one, a transparent whatever disclosure, but it also, a thought out disclosure letter could also limit their risk and liability, so to speak. Right? That's what you're trying to say.
Yes.
Got it. Okay, let's see what you have in store for us after this.
So these are the CPs, which are very, very critical. The CPs are actions that are to be undertaken prior to receiving of investment. The conditions precedents are identified, or are such actions which come from diligence findings, or they are general actions that need to be undertaken as per the Companies Act, or if the company is receiving any foreign investment from a FEMA perspective. any actions that need to be taken from a FEMA perspective. So there are general standard conditions precedents, such as getting a valuation report, or issuing passing necessary resolutions for private placement, making private placement offer letters. So these are general actions that need to be taken part as a part of CP, whereas diligence findings are the important ones. The investor does its diligence. It puts out the list of non-compliances, and then it identifies whether such non-compliances would form a part of form part of pre-investment, whether they need to be resolved at a pre-investment stage or at a post-investment stage. The founders need to be very careful here, because this might impact the timelines of the transaction. Given that between execution and signing of the deal and the closing, the company is literally at a standstill. So this is a very critical period for the company.
Got it. And perhaps whatever can be regularized without, during the course of that time period, maybe there is merit in looking at it and regularizing it as we move along, so that why have it as a CP or a CS sitting there? So if the time frame permits it, we can perhaps take those actions.
Yes. So generally, diligence also, term sheet and diligence can happen in the parallel. However, it's advised to sign up a non-disclosure agreement, because you end up letting out your information about the company. Likewise, CPs can also be, like a list of CPs can be demanded prior to execution of the transaction, and founders can work towards completion of CPs before they sign the transaction documents also.
Got it. Thanks. That's very helpful, actually. The parallel activities, and given the parallel activities happening in parallel, the criticality of having a non-disclosure agreement where given sensitive information is being shared. Thanks, Aditi. That's a big key one. I think a lot of us missed that one out, of the need of an NDA while we do things in parallel. Okay, I think you finally have a deal for us. But I'm intrigued by the pre-work, but I'll leave it to you.
Yes. So this is the deal day. This is obviously an important day for both the investor and the founder and the company. This is the day on which the relationship of trust is established between both parties, and obviously it's ever present prior to the deal also, but it's just established, and they are now one team, and they need to handle and take care of the company together. So this is an important day, as remittance of funds and allotment of securities happen on closing. The key thing that I want to highlight here would be one should not leave all the paperwork for closing on the very last day. Again, paperwork such as for board resolutions, shareholder resolutions, which need to be passed for allotment of securities and amendment of the AOA, all need to be drafted and kept ready, so that all that happens on closing is exchange of documents. So it is very important from that perspective. And also from a remittance of funds perspective, if the investor is a non-resident, and so he should get in touch with his AD bank and get all the paperwork done, such that there is no issues at the time of transferring the money to the bank account, to the company's bank account. So all that needs to be checked prior to the date of closing.
Got it. So we should also be receiving ready vis-a-vis our AD bank, versus just the investor who needs to send us money, doing their bits. Got that. That's helpful, Aditi. Okay, and I think you also have some conditions subsequent. I mean, that's not, the deal got done, I thought, perhaps not over.
So obviously, the excitement is already built in because the monies come in and hit the accounts, and it's a highlight moment for the company. But yes, there are certain condition subsequents that need to be completed post the monies come in. Again, the condition subsequents are identified at the time of diligence. Like I mentioned, when the list of action items come from the diligence, the investors and founders together decide what can be done as a part of CP and what can be done as a part of CS. So CS that way is very important. It is also important that the timelines that we put to complete an action item. So if, for example, any sort of filings that need to be made with the ROC, sufficient reasonable time should be taken to fulfill the CP, to fulfill the CS, because the CS also is like a covenant in the agreement and has direct consequences to the indemnity and liability provisions in the document.
Give me one classic example of condition subsequent, because what typically would is a critical condition subsequent, say, for example.
So it would include, filings with the ROC, which is if there's a director appointed, there would be necessary filings to be made. And sometimes there are certain milestones that are required to be met by the founders. So that, because it may lead to a second tranche. If a particular milestone is met, it may lead to a second tranche. So both the CS, it then acts as a CS and a CP to the second tranche, basically.
Got it. And there are certain, with the new directors coming in, like we were discussing a few days ago, some requirements around DNO insurances, etc. What are those about?
Right. So the investors, the investors have the nominee directors on the board. So they request founders in the company to provide for DNO insurance, and procuring that is also important within the timelines provided. So that is also a critical CS. You're right on that.
Got it. Because that becomes a sticky line, because from the perspective of what the investors think of it and what the founders can at the moment think of the having as a valid ask or request. So that while it's a CS to take, but what could be the fundamentals around it could be understood beforehand, I guess.
Absolutely.
Okay, so yeah, so we're done, I think, and and over to all of you to ask Aditi all the questions you have. Deepak, Atul, we look to you as to please tell us how would you want us to take up the questions.
So there is a question from Mr. Pramod Suri, that is, most of the investors don't agree to sign the NDA. How to handle such cases and safeguard your interests?
Deepak, we can't clearly hear you, but I understood the question is something on the NDA, and that investors don't agree to sign the NDA. Is that accurate?
Yes, actually, I have also shared the question on chat to you as well. So it is saying that they don't agree to sign the NDA, the investors. How to handle such cases and safeguard our interests?
Got it. So let me read out the question. Most of the investors don't agree to sign the NDA, Aditi. How to handle such cases and safeguard our interests?
So typically, a term sheet would have such clauses of confidentiality, wherein the require, if any agreement or document is shared as a part of the transaction, the term sheet would have a clause to protect that. But if it's a simple NDA, I believe if it's made with a request to the investors and the rationale is provided, given there is a lot of information which is confidential and important to a startup, we would come to a conclusion then.
Yeah, I mean, like Aditi is rightly pointing out, it's more a request. It is a term that you are bound by, both parties are bound by, basis the term sheet, which is confidentiality. good way to negotiate this could be that request them for a format and see if that covers our interest and say, hey, we are not going to give you one piece. Share your version of it, whatever you're comfortable with. But clearly, given information and data is being shared, given we have still not signed on the dotted line, it'll be great that we have something like that in place. So usually requests work, and if and given it stems out of the term sheet like Aditi mentioned, hopefully it should do the trick. And as we wait for more questions, this is you can route us questions. Deepak has graciously agreed to accumulate and assimilate all questions that may come up for you, and we'll he'll share them with us, and we'll be more than happy to answer all of them for you. So the question and answers don't end here, the conversation doesn't end here. So feel free to write into Deepak and have the questions be made available.
Yes, thank you so much, ma'am, and thank you so much, Miss Aditi. Though I have requested for the participants to specify any question if they have in the chat box, but anyways, I'm also sharing my email ID in the chat box, so you are most welcome to share your questions with me, which I can certainly route it to the Ketan legal team, and then I'll be routing the answers back to you as well. So you can, in case like you need some more time to think through the various aspects that has been discussed today, because yes, the aspects are quite technical, and we need to actually, most of them overflew my head. I need to actually do some homework. I should have done some homework when before I have attended this session. But yes, so in fact, if we do our homework, then we might come across some doubts, and those doubts can be written to me. I'll be more than happy to share with KLA team, and then would revert back with the respective answers from their side. So, right. So once again, thanking all of you, thanking our participants, our attendees, and for their time today, this evening for this important session. And thank you so much, KLA team, Shruti ma'am and Aditi for this enlightenment on the session. I had a question, but I believe that question would be more or less coming in the merger and acquisition workshop, since we have that Z channel issue where the founder was crying on the Z DNA, which I saw last Wednesday. So I'm still very much confused what is going on about all that. So I think that question will be much more relevant in the merger and acquisitions session. So I'll put it that time across with our participant with our experts. So thank you once again for your time today. And this is not the end. I'll be coming back to the participants with the calendar for the next workshops that are being planned. So very soon you will be receiving the emails from our side, and we'll all look forward to have your presence again. And also KLA team, thank you so much, and we look forward to your presence as well.
Thank you so much.
Okay, thank you so much, and a very good evening to all of you.